Listen, I don't have a specific presentation for you tonight. What I have is kind of a group therapy and discussion for us. The idea is that everybody in this room has been introduced to Power of Zero in some respect or another. Now, last year we had name tags with colors. At the dinner we had carnations with colors to say what stage you are in the process. We're not doing this time so that you can discover yourselves. Who is at your table and where they are. And I would encourage you to talk amongst yourselves and find out what are you guys doing? What are you guys doing? Because we really want to share this concept. The Power of Zero concepts are so mind-numbing that sometimes it helps to have reassurance that yes, there are other people in this world who are thinking the same things that you and I are. So my intent tonight is kind of to be a discussion leader, if you will, but hopefully to further and engage conversation with the people. We do have a little bit of prizes and fun things to kind of keep things light. So hopefully you'll work with me here and we'll have a little bit of discussion as we go. I do have a couple of quick disclaimers before we go too far. And number one, we're going to be talking about concepts that come from David McKnight, who is the thought leader and guru of all of this stuff, and the author of Power of Zero and Tax-Free Retirement for Life and some other things. The disclosure is in no way is David McKnight associated with Valark Financial or with our back office independent financial group. Disclaimer number two. A lot of opinions tonight. We're going to be trying to forecast the future. And our opinions and information are believed to be reliable but cannot be guaranteed. Please consult your tax and investment professionals. And of course, number three, we are talking about tax strategy tonight. I am not licensed as a tax professional, so anything I'm saying is in generalizations. We really need to have a qualified tax professional to talk with, which is why we have our good friend Lucia here tonight. So thank you, Lucia, for joining us. Appreciate it. So look, I speak in public a lot. And when I do this, I try to kind of mix things up and make it a little bit entertaining and try and have fun with it so you don't get bored of the same thing over and over, same style. For better or for worse, I got interested in Twitter recently, or X, or I always say I get interested in Twitter and X rather than say I got interested in X, because it comes out weird. But yeah, Twitter, for better or for worse. So I just want to throw around some stuff I found on X. And these are, I can't guarantee that this information is accurate, but it is compelling, interesting, useful. Let's talk about it. Let's use it as a basis for our conversation for tonight. So let's kick off our conversation tonight with this one. Back in December of last year, there was a stopgap budget bill that went out to prevent the government from shutting down. You guys remember this happening, right? And the first version of it that came out looked like this. And I think they had 48 hours to review that. And people flipped out and said, we got to cut it down. And they got it down to this size instead. So for our first question for tonight, and by the way, these prizes, these are really unique and special. So for the first one, first one tonight earns the "It's weird being the same age as old people" mug. First question of that one for tonight. How many people know how many pages was in the first version of that budget?
1,000.
Close.
1481.
Closer.
1,100.
Less. Or not closer.
I'm the one that doesn't do the math.
Any other guesses?
1460.
More than 1,400?
1570.
Keep going.
60.
Closer. I'm going to go with it.
Thank you.
1,547. So 15,047 pages on the initial version of the spending package. Question number two for the taco versus burrito game. How many pages did it reduce to? From 1,500 and change, what did it go down to? 148 I heard? I heard 110. Who had that? 110. You're close. It was 116. Awesome. Question number 3. From the difference in those page amounts, how much of a reduction in spending did it equate to? 0. Who said it first? I think Zanko back here. Sam, would you pick a prize for Mr. Selecki? Yeah, 0 reduction. Most of those pages were corrections or, wording additions or so forth. So, I thought it was interesting for us to take a look at this little video that came out on Twitter just after it was signed.
Okay, so we just finished passing all the legislation. Congress just blew a $200 billion hole in the Social Security Trust Fund, and just in the last few days spent a total of about $300 billion, which is added straight onto our debt and deficit. Look, I get it. People want to spend money on stuff, but we're digging deeper and deeper into a hole it's going to be harder to get out of. This has got to change. 2025 has got to be different, very, very different, and we're going to be in a real world of hurt. So look forward to 2025, new Republican majority in the Senate, a Republican entering the White House. But it's time for DOGE, and it's time to bring about pro-growth policies. It's also time to cut the wasteful, harmful government expense. Here's to 2025 and all we can accomplish there. Let's get to work, and let's not mess around anymore.
That's Senator Lee from Utah, just sharing his thoughts on that. Yeah, we did the big cut, but nothing has really changed yet. And that's really what we're here to talk about is, the whole reason we do Power of Zero is because we expect taxes to increase relative to the amount of national debt that we have. We haven't even talked about unfunded mandates yet. So, gosh, the question becomes, what happens next? We have a new administration. Are they going to change things? They're going to fix things? And looks semi-promising, but let's walk through a couple of slides here. So, number one, current spending bill. I mean, that's the one that they just published. It's a lot bigger. It took over 200 years for the U.S. debt to reach 12 trillion, but now in just 4 years, we've added 12 trillion. I mean, it's just straight up. I mean, you know this, right? So we talk about when you hear Trump says he'd like to extend the tax cuts, he'd like to cut tax, he'd like to take away income tax. The reality is that Trump does not control taxes, Congress does. This is really what we're dealing with is this problem. Exponential growth of the national debt. This was a little while ago, 31 trillion. We're now at 36, I think, right now. Deficit, surplus spending, deficit spending, we're just spending into the hole over and over again. I think we're starting to get a grip on it, but we have such massive amounts here, we really have a long way to go. We talk about trillions. What does trillion mean? So I found this cool little slide that says 1 trillion in $100 bills. Here's this guy standing next to pallets, but there's how many pallets it would take to be 1 trillion. And we have 36 trillion of it. So I'm having trouble seeing how getting rid of the IRS or cutting taxes is going to help us in the long run. Now, notably, the whole budget deficit and all of that was absent from the conversation during the elections for the president. Nobody wants to talk about debt spending and taxes during an election. But now that we're past that, we're seeing more and more, especially on Twitter. Elon is big on this. He's talking a lot about that if we don't get our spending under control, we will be de facto bankrupt in America in very short order. David Walker, U.S. Comptroller back in the 90s, quit his job because he realized that Congress was not engaging in a meaningful manner on reducing the deficit. And so he went on to consult and write books and things, and he says that if we don't double taxation by 2030, and like double what we take in, we are heading into a negative debt spiral from which we cannot recover. He said this in 2018. And now we're 6 years later with the debt almost, I'm not sure what it was in 2018, but a lot, but now it's more. This is the part that scares the bejesus out of me. We haven't even talked about the unfunded mandates yet. We're only talking about the 34, 36, 37, whatever number it is of deficit that we have now, national debt. We haven't talked about the 75 trillion that is all the money that we have promised to occur in the future that is not even built into the budget just quite yet. So it's unbelievable numbers in my mind. I don't know exactly how they're going to solve it. I can't save the world. My goal is to save one client at a time. And I'm glad that that's why we're here. I'm glad we can talk as a group about some of these topics and kind of go from there. You know, the amount of regulation that we have out there is extraordinary. These are the number of pages on our tax regulations over time. I used to believe that things got more complicated just because the internet came around and computers could handle more calculating. So just because they could, we did. It didn't used to be this complicated prior to the internet. So this was an interesting thing that happened a little while ago. This is the first time that Doge appeared on the floor of Congress. And here's Doge coming in to take over Washington because it is functionally inevitable. If we don't start doing the cutting and raising our income and dealing with our problems with spending and debt, we won't have a country any longer. It's as simple as things like the Postal Service is inefficient and lost $100 billion since 2007. And we can go through the list. You've probably seen some of the things that I've seen on the Doge Committee. The most recent one, my favorite, the $50 million for condoms in Gaza.
Saw that one.
Yeah, I know. We could go. There's so many things that are popping up. What was the one? Researching how to untangle pretzels. Did you hear that? How to unwrap? Really? So I know this is a whole lot of numbers and data. Maybe some of you have seen this, maybe not. This is the national debt clock. And it shows right up at the top here somewhere the amount of national debt at whatever time you go and look at it, which is 36.4 as of this afternoon. But very recently they added the Doge clock, which is how much money Doge has saved in the last whatever time period we're measuring. So 41 billion in. Okay, that's pretty good news, but we still have $107,000 of debt per citizen. You know, when you start to dig into some of this stuff, where's the one? Oh yeah, money supply. The M2 money supply, which is the most basic measurement of how much capital is sloshing around in our economy, in 2000 was 4.6 trillion and is now 21 trillion. Do you understand what inflation is? Inflation is not the cost of things going up. Inflation is the value of the dollar going down. So when we increase the money supply 700% since 2008 and the financial crisis, it's easy to understand why everything costs more today. So not only do we have to cut spending and raise taxes, we also have to reduce the money supply. There is a lot to get done. So as much as Trump says, I want to do this and that, I'm not convinced we're going to be able to exactly pull it off. But let me stop for a moment here and just open it up to the room. Any thoughts or questions on anything we're talking about so far? Any reactions? Yes, sir.
I've read that President Trump would like to eliminate the debt ceiling.
President Trump would like to eliminate the debt ceiling. Yeah.
What prompted that? Or?
Well, simply so we don't have to go through a budget reauthorization every 9 months, which is what we've been doing. And then it turns into a big old battle, and then there's threats of the government shutting down, the money and time wasted on doing that process. I think that's what he's getting at. I don't think it is to spend an obscene amount of money. I think he understands what's going on with the debt. I think just taking away that silly process. Thank you.
What about tariffs?
What about tariffs?
Because I know that's supposed to start tomorrow, right?
Yeah, 25% on Mexico and Canada.
And 10% on China.
I didn't hear that one, but okay.
Yep.
So tariffs, in my opinion, are a negotiation tool. They are designed to force people back to the table. We've seen that take action with Colombia when they wouldn't take back the jet with their citizens on board. So in my opinion, it's a negotiation tool. If tariffs go into force, all it does is really level the playing field between, let's call it Chinese goods or Canadian goods versus domestic. So if you're buying domestic steel or lumber, it now levelizes the price between what you would buy from Canada and makes them consistent. Now it makes American industry more competitive. I'm not overly concerned about tariffs. Some people think it is inflationary. I can see how they would, but I don't think they're taking it to the second step, which is it's a negotiation tool. Nobody wants a trade war. We want to bring people back to the table to negotiate fair deals.
Charles, do you know what the interest is on the debt each year?
I know it is more than what we spend for national defense and very quickly approaching what we spend on Medicaid. I don't have the exact number. It's probably on the debt clock. I don't know what the number is. I'm sorry. Do you? Or, close to? Yeah, okay.
It's supposed to go up by $1 trillion every 100 days.
Some ridiculous, unbelievable, incomprehensible figure, yes.
Yeah, I'm pretty sure that it's something like that.
Yeah, yes, please.
Yeah, I just heard that it would cost, in order to pay back our debt right now, it would cost at least every American citizen to pay over $100,000.
I heard 107. Yeah, so you're about right. That's correct.
One time or per year?
One-time deal. One-time deal.
I have another question.
Yes, please.
What about lowering the talk of lowering the corporate tax rate, which brought in money?
Thank you.
Previously?
Great transition. Last time we did that, we actually got more in corporate revenues than we did when taxes were higher. The reason is when taxes are low, people start settling up their tax bills. They onshore assets, they reshore assets. You and I, we go through Roth conversions, we pay tax money because it's cheap, it's on sale. So that's the philosophy behind lowering tax rates and having it increase revenue. My question, and I don't have the answer here, this is kind of long-range thinking, how much time does it take before all of the convertible assets are converted? And now there's nothing left to tax. I'm not sure. I think we have a ways to go, but these are things that I think about at night. Here's another interesting slide related to that. There's a lot of talk about the wealthy don't pay their fair share. And this one suggests that the top 1% of earnings actually paid 45% of their personal income taxes paid. 5% was 65. We go down to the bottom 50% and they pay 2%. So it's not a fair argument to say that the wealthy are not paying their fair share. And the scary part is the wealthy is right around in here somewhere. It's basically you and I. Here's another quick question. Does anybody know the cutoff for the 22% tax bracket? Anyone except Lucia? And this will be for, what's the prize?
The flappy guy.
We have wacky waving inflatable tube guy. It's a little less, I think, isn't it? Lucia, what is it? 250? 200? Okay, so did anyone have 200? I don't know. All right, here's another one. Where's the cutoff for 24%? Adjusted filing jointly. 182. Who said that one? 384? Yes, sir. So think about that now. A household of 385,000 income is the top end of what we'd call normal taxation. The middle range is that 250 to 380. If you have a husband and wife making roughly 150 each, which is kind of, regular pay, I would think, maybe a little more, a little less, but you're right in that target zone. That's the area that would be targeted by this kind of stuff. So it's you and me that they're really interested in taxing, and that's why I think it makes a lot of sense for us to get ahead of that with Roth conversions and some of the other things that we will talk about. If you have any doubt in your mind that taxes are going up in the future, I encourage you to watch this short little video. Jot it down in your notepad if you need to. It's called The Tax Train is Coming. This was published by an independent filmmaker back in 2018. He interviewed David Walker, David McKnight, a number of congressmen, some economics professors, people that would know about this stuff. And the things that they say are kind of astonishing. When you watch this, remember it was made pre-COVID in 2018, and the national debt from the time then till now has functionally doubled. So if it was a problem then, it's a problem twice as big at this point. Couple of last thoughts on this before we kind of open up and chat a little bit more. I love this one. Biggest scam is paying taxes on the money you make, and then paying taxes on the money you spend, and then paying taxes on all the things that you own just because you own them. Income tax is the fine you pay for being productive, while welfare is the reward you get for being unproductive. I am optimistic that these things are changing with the new administration, with DOGE. We're already seeing progress in this direction. I question how far we can get with it before taxes have to go up. In my impression, Trump will be able to extend the tax cuts maybe for a year or 3 or 4, but remember that Congress controls taxation, and they're going to have a lot to say about this kind of stuff. Who was it, the guy before Speaker Johnson? I can't remember his name. The guy who got fired, they kicked him out because they didn't think he was aggressive enough on reducing spending, and Speaker Johnson almost got kicked out for the very same reason. So we think they're on it, but I think it means taxes going up for you and I, which takes us to the power of 0. In a perfect world, everything would be tax-free. Everything would be in a Roth or in a LERP. So what that means is transitioning from IRAs and 401ks and paying taxes at a controllable rate rather than a future higher uncontrolled rate. We don't know what it's going to be in the future. But we also know that eventually we're going to hit what? Required minimum distributions. And for most of the people in this room, you're all more or less in the same boat. You've done the right things. You've saved. You've invested. You have retirement plans. You're invested in growth-oriented stuff that goes up. We're expecting good market performance over the next bunch of years. So your tax-deferred stuff continues to defer, and the tax bite gets worse and worse until age 73. The feds say you must take money out of your IRAs and pay taxes, and we have a formula in mind for you. And if they raise taxes between now and then, you are paying taxes at a higher rate than today to get the money out, and they're forcing you to do it. When we run the math on this stuff, it is scary how much we have to pay in taxes to get the money back out again. And that's why I thought we should get together as a group to chit-chat and see, are we all thinking the same thing? So, again, let me open it up to conversation or thoughts for a bit.
Well,
yes, sir.
I tagged you earlier about the ERS that is...
ERS. Yeah. So, External Revenue Service. Great idea. I guess we don't have a service that tracks what other countries owe us. In terms of tariffs or taxation, I guess it's a good idea. Will it replace the income tax? What do you think?
Hopefully, I'm optimistic.
I'd like to believe that.
That's a system that was in place, going in just before the Federal Reserve was instituted. Say pre turn of the century to 1900.
Yeah.
1890s, whatever.
I wasn't aware of that. That's good news. Anyone else aware of that?
I've heard.
You've heard that?
Yep.
Okay, cool. I hope it works out. It'd be...
Can you expand a little bit more about that?
Maybe the gentleman can. The External Revenue Service. We've got the internal, right? But please, go ahead.
From what I understand, the government was very prosperous in the 1800s. A lot of gold, a lot of silver, and they didn't have an income tax. Money was gained through tariffs from other countries that wanted to deal or sell their goods in our country. Our prosperity was based on tariff income. Tariff income, yeah, rather than income. So the people outside our country paid for us to be prosperous, not our own. We didn't. The citizens of our country didn't. Pay to run our country.
And I think that's the idea is that, sorry?
There were dynamic social changes. People are coming in off the farm.
Yes.
But it's complicated.
There's a huge industrial revolution going on as well.
And I think that the powers that be are thinking this all through, and maybe some is experimental to see what works and doesn't work. But the people have, is it a mandate? I don't know, might be, to try something different. And I think that's what we're trying. And the External Revenue Service has something to do with that. Yes, sir.
Aren't we already doing that? If we're charging tariffs, that money's got to go into the U.S. government somehow, right?
Yes. If I'm not mistaken, it raises the cost of goods, and this is what we've been talking about, is if you buy a widget that was made in China that has a 25% tariff, they're going to pass that 25% on to you as the consumer. But it also changes the demand level for that good. You might buy an American widget rather than a Chinese one if they've been priced equally because of the tariff.
I know the prices get passed on to the consumer, but somebody has to be collecting this money, because if the tariffs in the past were the only way of revenue, it had to go into the government.
There's got to be a mechanism for it. I don't understand that mechanism, but maybe that's what the External Revenue Service is.
But also think if you didn't have the income tax, you have a $20,000, $30,000 per year extra buying power to overcome that.
Which goes into the economy and accelerates stuff, and you buy and sell things, and when you sell or buy something, there's a tax that's due, and that goes back into the coffers. And I think that's part of the plan, is that the faster the economy moves, the more taxation there is that occurs, which helps to reduce some of these bills. But my concern is it's so massive. I'm concerned about, there's some dates coming up that have been, spelled out. Does anybody know what happens in 2030 if we don't change taxation? It has something to do from David Walker. Well, that's close enough. I'm going to go with that. Where was that? Okay. That one said in 2030, if we don't raise our taxes, we enter a negative debt spiral from which we cannot recover. That's according to David Walker. Next prize up, Sam. What happens in 2034 for the Sauce Moto dip clip that attaches to the vent of your car and holds your McNugget sauce so that it doesn't spill?
Doesn't have to be a McNugget.
So what happens in 2034? And actually, I heard it out here a minute ago. Somebody had it. Social Security, something about Social Security, yes? That's what it is. You don't want that one? All right, I'm passing it to, here you go, you're close enough. So the Social Security will reduce to 77% of what the promised payments are by 2034 unless we solve the Social Security problem. Because the Social Security Trust Fund runs out, and by law, it's already written into law, when that happens, we have to cut Social Security payment.
Charles,
Yes, please.
I want to talk about this consumption tax.
I haven't heard that one.
Yeah.
Consumption tax. What have you heard? Tax.
Yeah, rather than doing away with the income tax, and they're playing with the idea of consumption tax. So, yeah, so the people, if you choose, and again, I think comes the idea, again, if you have more money in your pocket, you're spending more, so you're consuming more, so you're paying taxes, but the people who can afford it, or who are purchasing are the ones who are.
I haven't heard that one at all. Yeah. But I'm interested in all these creative solutions. We'll see what happens.
There's so many, I think I'm hopeful because there's so many ideas out there, and I'm a huge Elon Musk fan. Mm-hmm. And I think we've got really smart people in good places.
Proportionally, that affects the poorer people greatly more than everyone else.
Well, but
because they have to consume
the 5%.
The basics that they have to consume, they're paying tax on. Where the basics that a person that can afford it
marginalized, just like the income tax where they pay. But again, that would be difficult.
The groceries are the same price for someone who's making $40,000 a year as someone who's making $150,000. The amount for groceries now is ridiculous.
But maybe I didn't hear the whole plan. It could be just for certain goods. Do you know what I'm saying? It may not be for necessities. Maybe it's for vehicles and furniture.
It proportionally keeps the poor people poor.
Necessities for everybody.
No, I
Everybody
know
has
that.
to have a car. It's hard. Where do you put the line?
No,
It's hard.
I like I said, I just heard that.
Yeah, I'm just saying it's really hard because you're trying to not tax everybody so much, but then you have the young
I think
people,
the thing
our
is-
children are having a hard time buying homes
Yeah.
and doing and even
Yeah.
getting an apartment. For God's sake, it's $2,000 for an apartment.
Yeah.
So I mean, it's getting where they're making good money, but they still can't afford stuff because. My daughter told me yesterday it was $95 for 2 bags of groceries.
Yeah.
She's all
I
by
believe
herself,
that.
and she's, like, it's getting harder, and these kids have good jobs.
Yeah.
And they can't afford it. So God forbid someone who doesn't have an education doesn't have a good job. And
Bob, you
how
have
would you get out of that hole? It's hard.
I think we need, I don't agree with a lot of the conversation, but I think we need to think differently. And the state of Connecticut's talked about, instead of having a gas tax, now that we're converting to electric cars,
Yeah.
we have to think different. So I'm just saying.
Yeah,
The world is changing, we need.
Yeah, but then you get to the whole thing that Eversource can't handle all of it.
Well, there's that too. The grid and everyone's electric bill has gone up, and we have the stupid delivery fee. All of that. I don't know how it's going to get solved.
Yeah, there's just so much.
So that's my worry, and that's why I'm glad we're here and we're talking tonight, is I don't know what's going to happen. I do believe that we are starting to get on a path that it is a better, different path. Will it solve the problem? I'm not sure. Should we get ahead of it by continuing Roth conversions? I think so. There's only one scenario where Roth conversions doesn't make sense, and that's if taxes go down. If they stay the same, no harm, no foul. If they go up and we convert now, we win. If taxes go down, all right, it would have been better to wait. What's the likelihood they are going down?
Zero.
I don't think it's a zero number. It's a non-zero number, but I'm not sure if it's 1, 10. I don't know. But I think when we have uncertainty and we know that these are some of the lowest tax rates in recorded mankind, then maybe it's a good idea to get ahead of the ball a little bit. Yes, please.
What is the LERP up there?
Let's talk about that. I'm going to circle back to that in just a moment. Okay. So I'm going to go ahead here a little bit more. If you want to jump in, let's keep it a free-for-all. This is great. But I also want to mention it's not just income rates. It's also capital gains rates. Capital gains rates are currently low, but in just about every budget proposal since 1980, they have tried to increase the capital gains rate. In 1980, Ronald Reagan reversed the trend of raising capital gains rates and dropped to 28. Think of where we are right now. It's 15, Lucia, maybe 20 at the high end. So 28, that was considered low. And here we are at 15 to 20. Clinton briefly increased rates and then lowered them to 20%, which is kind of the high end of where we are now. Obama proposed raising capital gains to 39.6, but also added the Affordable Care Act surtax of 3.8% on certain investment income. 2021, Biden proposed significant increases with the Build Better Back plan. 22 and 23, renewed calls to increase capital gains. 2025 fiscal year, when Biden was putting together his budget, called for a near doubling of capital gains rate. Kamala proposed raising it to 28. Fortunately, there has been no increase finalized since 2021, but it's clear that capital gains rates are on the chopping block. So I think it makes sense as much as possible to convert taxable assets to tax-free ones wherever we can. Regardless of whether we think taxes are going up, down, or sideways, there's enough of a problem out there. I think it behooves us to get ahead of it, and that's why I'm glad we're here talking. Let's do a couple of last little quiz questions, and then I'll go into kind of the 30,000-foot view on the game plan. Does anybody know what was the highest tax bracket in history? 94. Who said 94? Right over there. During World War II, 1944, 45, in that era, which makes sense. We were at war. We needed a lot of money to do stuff, right? Okay. What was the second highest tax rate? 70. Where was it?
Yeah, but you can keep it.
Yeah, okay. All right. You want to donate it to someone? Okay, here, we'll go right over here. There you go. Good. So that was 70 in, interestingly enough, 1970, which was kind of cool. And then, of course, now we are down to the 22-24% tax range. 24% is my favorite tax bracket. Anyone want to take a guess as to why 24% would be my favorite?
Ronald Reagan jumps up after that?
It does, jumps up sharply.
It's the widest tax bracket.
It gives us a lot of room. You're on the right track. So the 22% bracket, many of us fall in that range. And one of our first thoughts, we talked with Lucia a lot, let's figure out how much we can convert to fill up the 22% bracket. And maybe some of you have had this call with Lucia and I, and we say, but what if we did 24%? Why 24? Because it's only 2% more, and it gives us a heck of a lot room. We get to 380 something and change, right? So a lot more can be converted for only 2% more, plus the 24% bracket is still less than what the 22% bracket will become. 22 is going to 25. So if we wait till 2026 when tax rates go up, unless Trump extends it, we would be paying more by waiting than we would by converting as much as we can in the 24% bracket. I know it seems like a lot. The taxation on converting $385,000 and change or something is a lot. But we owe it. We do. We just do. The question is, at what rate would you like to pay? Is it at today's low rates or tomorrow's likely uncontrolled, unknown, and higher rates? All right, here's another one. What was the highest capital gains rate in history? We've talked about income rates. What was the highest capital gain rate in history? Much closer, 39.9. I think it's close enough. So just think about that for a second. We're at 15 to 20% capital gains rate. It has been as high as 39. They've been squawking about raising it, 28, whatever it is. Capital gains rate, capital gain stuff, I think, is at risk. And so we may want to work on downsizing and controlling some of that too. And we'll get into some of that strategy. So the basic premise of Power of Zero and tax for retirement is to accelerate taxation. And in a perfect world, we would have everything except your rainy day fund would be in a Roth or a LERP. We'll get into what a LERP is in a second. But a Roth, people ask, I can't do a Roth, I make too much money. Remember, there's a difference between the contribution to a Roth and a conversion to a Roth. The feds would be perfectly happy if you chose to convert everything you've got all in one shot, because you'd pay taxes on the whole thing, they'd get a pile of money, they'd be very happy, yes please, thank you. But anybody can convert an unlimited amount of money from your IRAs into your Roth plan. You just pay taxes when you do so. When you do so, it is income tax rates, whatever amount you're converting, gets added to the amount you have earned in your other sources of income to become the total. And Lucia and I will have a conference call with you to understand how that impacts you. A LERP is essentially a tax shelter. It's based on life insurance. LERP stands for Life Insurance Retirement Plan. And it's not because you need life insurance. Most people have more than enough assets. Your kids are out of college. We don't have a lot of obligations. What the heck do we need life insurance for? Well, we don't. But we might be able to use the cash value account and some of the other benefits that come along with it. So I'm going to show you a hypothetical LERP illustration. I know these numbers are really tiny and might be difficult to see, but I'll kind of break it down for you. Here's how it works. In the end, it is a life insurance policy. It does have a death benefit. In this case, from day one, a little more than $500,000 of death benefit that would pay tax-free to your beneficiaries. It is funded with large deposits. This one is $37,000. That is not the cost of the life insurance. It is truly a deposit of which the vast majority goes into an investment component. So on day one, $37,000 is deposited. On day one, it's worth $29,000 as an investment value. The difference went to pay for the life insurance, and some of the expenses are higher in the beginning, lower in the end, but that's the idea. This goes on for 7 years. 7 years is not random. 7 years is because the IRS feels that these things are so powerful, they're going to control how much money you can put into it. In this example, this person wanted to deposit $259,000. If you had that sitting around and wanted to drop it into a LERP, I would not advise you to do it in one shot. It would not be efficient. It's better on the IRS guidelines to dribble it in over a period of 7 years. But at the end of those 7 years, when $259 has been deposited, your investment value is $273. You say, I hate this thing, you walk away. You would recover almost every dollar that you've put into the thing. So it truly has an investment component. Now we're done making deposits. Now the investment component continues on. Again, some point in the future, you say you want out, you can cash out and walk away. There would be a taxable event, but you can recover your dollars. The real reason we want it, and just arbitrarily I'm showing 15 years out, we want to start a stream of income. This one is $37,000 that is tax-free. And that's one of the features of a LERP, is it allows you to take tax-free income, tax-free non-reportable, that you live on. That's still not the main reason I recommend it. The main reason is because over here on the death benefit, if you pass, your heirs will get that death benefit. But if you get sick, they will accelerate the death benefit, and you can use the death benefit to pay for your long-term care. These we want for long-term care more than anything else. Think about what the normal process for long-term care would be. You would buy a policy for Mr. and Mrs., right? And I can tell you for a standard policy that would, his and hers discount, that would take care of the bill, you're probably $10,000 to $15,000 a year of expense for that. What happens if you pass away peacefully in your sleep? Do you get that money back? No. What happens if you pay and you live to a nice age of 95, you've paid the bill, and then you get sick? It'll pay. But for how long? You're 95. Long time? So you've spent an awful lot of money for a benefit you're only going to see for a short period of time. So some smart guys at the insurance company sat around at a table and figured out, if our customer has a policy with us and they get sick and go to a long-term care home, what's the likelihood they're going to cancel that policy? Like zero, because they know they're on the way out, right? So we know we're going to pay a death benefit. It costs us nothing to do. Why don't we just accelerate the death benefit to these folks while they are alive and they can use it for long-term care? So in a LERP, we are transferring money from one pocket to the other. When it goes into the other pocket, it goes into an investment that grows. It can provide you with a tax-free stream of income. That's one way to recover your money. Another way is you pass away and it goes to your heirs and they recover it tax-free. But the most important way is that we recover the money that's been invested through a long-term care payout that helps to protect you at essentially zero cost. Love LERPs. It's the only program out there that will accept large deposits and immediately make them tax-free and immediately give you a benefit. So in the end, we want an after-tax bucket, and this I call it the rainy day fund. How much should be in your rainy day fund? I heard it. 6 months. 6 months of expenses. The other portion of your money, probably tax-free, probably a Roth. Another portion of your money in a LERP. Now, Roth stuff comes from 401ks and IRAs that get converted. LERPs are usually funded with stuff that was previously subject to a capital gains rate, a stock, a mutual fund, that maybe we can liquidate and just from one pocket to the other, take it from the taxable column, the capital gains rate, which is favorable, but is at risk, take it from that column, put it into the LERP pocket, not only get a tax-free stream of income, but pick up a free long-term care benefit. Of the money that is in the Roth IRA, we're going to split that into two separate places. Of the money that is in a Roth, we want a roughly 50-50 split between a principal protection plan and a regular old diversified portfolio of mutual funds and ETFs. Principal protection plan, as the name implies, We want something that gives you a guarantee of principal, never goes backwards, always goes forward. Cash is a good example. A CD, a money market. That's all right. The rates are not exactly spectacular, but they're not terrible. In this illustration, we put $400,000 into the principal protection plan. It is invested in the market. As the market goes up, so does the balance of your investment. When the market goes down, you get a zero rate of return, meaning no loss, no gain, but no loss. Your account stays exactly the same balance from one day to the next in that scenario. In any other investment that had a 0% rate of return, exactly zero, your account would still go down. Why? Fees. So this does not bill its fees in the same way. It's a return sharing arrangement. They're going to keep a portion of your return. If you put money into your savings account at the bank and they're paying you 5% on your CD, you know damn well they're loaning it to some kid for a car at 9%, right? That's how the bank makes money. Same concept, return sharing arrangement. So when the market goes down, you do not. Market goes up, you continue to rise. Market goes down, you do not. At some point prior to that, we are doing Roth conversions. You start this as an IRA, and then internally we convert it to a Roth each and every year until eventually the thing is fully into a Roth, and then we switch on income. This is designed as a private pension. It's designed to give you a guaranteed lifetime stream of income, and in this scenario, in year 1, well, year 8, the first year you're taking it, it would be $52,000 of income. But what's really cool is the income continues to rise each and every single year if the market goes up. If the market goes down, you do not. Your income stays the same from year to year, but when the market rises, you get raises. Here's the crazy part. I always try to find a balance here that is close to 100,000 so it makes the math easy. Closest I can find right now is 154. If you had 154,000 in the account, it is spitting out an income of $75,000. What's your rate of return? At 150,000 of balance, it generated 75 grand of income. It's ridiculous, right? Can we agree? It's ridiculous. By design, it will burn down the principal of the thing. It will eventually have zero principal in it. However, the income continues. The concept here is that if you were replicating this in any other scenario, you would have money in the bank, it would generate interest, and you're trying to give yourself a raise to combat inflation, you're eventually going to burn down your principal, right? At the bank, once the principal's gone, you have no money left, your income stops. Here, they've actuarially spread it out over a pool of people to make the risk go away so that they can continue to pay the income. I love this thing for that reason. For one other benefit, anytime that there is cash still left in the investment and you have income, you can double the income in the event of a long-term care scenario. So now when we're designing Power of Zero, we're curing long-term care with a LRP or with a principal protection plan. Long-term care is taken off the table at that point. Finally, this is half the money. The other half goes to a regular old portfolio of mutual funds. And this is not a recommendation. Don't go buy these funds. But the point is that as we've always seen, you've got the pie, right? Mix of stocks and bonds and stuff. So in the end, Roths are both, or IRAs are both undergoing conversions to Roth. You have a portfolio of mutual funds, you have a principal protection plan, both converting to Roth. Eventually they become tax-free. One is in a principal protection plan that doesn't have a lot of investment selection but generates a high level income. Roth, in the funds, we can invest in anything we want. We can change the portfolio, take advantage of things that are cool. We can become conservative when we want to. And then finally on the side, the LRP is there protecting with long-term care. A lot of moving parts in all of this. The message I want to just deliver, we don't know what's going to happen. I hope Trump is successful because if he is, America is successful. We actually call it getting to zero because when we want to not only get to the zero tax bracket, we want to get to zero worry. You know, the ones I like the best are ending the worry. over taxation and future tax increases. If taxes double in the future, who cares? Twice zero is still zero. In the end, I've been looking for something like this for a long time, and went to some conferences and really dug into what David McKnight was talking about, and it really makes a ton of sense. And as we've been rolling out to clients, they've found it to be very successful. I hope this is useful for us to get together and kind of digest and work on some of this stuff. In the end, we run a pile of math. I mean, those of you that's seen the book, it's like that thick when it's done. Now we boil it down to 3 pages or less of recommendations, but all that that's the supporting data. And that's because we want to get it right. We are trying to find the bleeding efficient frontier of taxation and efficiency. And I would encourage you, if you haven't too, let's go through the process. Thank you. I'll quit for now. Thank you so much. Thank you. And we'll enjoy dessert and hang out for a bit. Thank you so much.